If you caught Monday's kickoff video, here is where those rate projections actually hit your loan file this week. So 12 basis points, that is how much the 30-year fixed rate has moved in just 2 weeks from a 7-week low of 6.43% on July 2nd to 6.55% on July 16th. And it happened entirely because of oil, not the Federal Reserve. I'm Robert with Open Lane Funding out of Spokane Valley, Washington. Let's break down exactly what moved and what the smart investor does with this week. Freddie Mac's survey printed 6.43% on July 2nd, then a 6.49% on July 9th, then a 6.55% on July 16th, the sharpest 2-week increase since spring. The 15-year moved in lockstep, from the 5.79% to the 5.93%. Now, this is not a credit spread widening. This is a treasury market repricing after fresh United States military strikes on Iran sent West Texas Intermediate crude oil from roughly about $68 a barrel to $82 a barrel in just under 2 weeks. So here is what most people miss. June's price consumer index actually fell 0.4%. That is the biggest 1-month drop since April of 2020. That should have pushed rates lower, but it didn't, because the survey week caught the oil spike before the disinflation data could offset it. The two conflicting signals, and oil this time won this round. So if this kind of rate mechanics breakdowns is useful, go ahead and hit that follow button, hit that subscribe button now so you don't miss Monday's economic indicators video. For debt service coverage ratio borrowers, best execution pricing on the top tier 780 or better credit, about 1.25 or better debt service coverage ratio, the 65% loan to value has likely moved from the 5.8 to about 6.12% range. Now back toward the it's now back towards the 6% to the 6.35%. Standard tier pricing is still holding near that 6.25 to 6.6%. And the as of the report date, there's current lenders are always going to be making their own changes, right? Here is the investor action plan. CME FedWatch shows an 88.8% probability that the Fed holds the rates on July 29th, essentially locked in, right? But the September odds of that September hike odds have now actually increased to 44 to about 51%, and oil sitting near $82 threatens to reverse June's disinflation in the July CPI print. And this is all due August 12th. If oil holds here or climbs further, expect rates to stay elevated or rise into the fall. Now, that means that if you have a deal that works at today's pricing, you better lock it in. Do not wait for a dip that Iran's and Hormuz risk could erase. So get into it. Get that deal started. Locally, this matters in Spokane too, where 42.9% of active listings have already taken a price cut, giving buyers negotiating room that practically or partially offsets the higher rate. That's pretty awesome. So rates moved on oil, not the Fed. And the next real catalyst is the July 29th Fed decision and the August 12th inflation print. If you want the actual loan scenarios and deal structures behind these numbers, book a call at openlanefunding.com. Make it easy, give you details. Just let me know. I'm here to help you guys in any way that I can. Otherwise, I'll see you guys on Monday with the economic indicators. Thank you, guys.